Hey there, and welcome to another episode of Tax Sherpa Stories. So, this is the podcast and video series where we like to go over all kinds of tax issues that are for people who are, usually solopreneurs or small business people. And the reason that is our tribe is that those are my people. So, I'm Neil, I'm founder of Tax Sherpa. I've been a small business person my entire life. I realized shortly after I graduated from college, I am unemployable. I don't like people telling me what to do. And the people out there doing their own thing, whether it's contract work or they own a small business or what have you, generally they also are unemployable. So if that's you're in my tribe as far as I'm concerned. And my mission and Tax Sherpa's mission is to save as much money as is humanly possible on your taxes. As far as I'm concerned, any money that is saved into your pocket instead of the government's pocket is a win. And the more, the better. What we do is we help clients with tax strategy and optimization, entity structuring, all those kinds of things in order to achieve that goal of saving as much money as possible on their taxes. So it is today, September 20th, and a lot of people are getting their K1s. K1 is your statement of shareholders' income deductions, credit, etc. Is the actual name of the form. And what it does is if you own a part of a pass-through company, it could be an S corporation, could be a partnership. There are a few others like 1041 have K1s as well, but S corporations and partnerships are the vast majority of the K1s that need to be dealt with. So on the last episode, we talked about how what you should do to review your K1s. You should look at the income and expense, you should look at the distributions, you should look at the full return and make sure that things are being filed as they should be, all those kinds of things. So on this one, we're going to say, okay, past that, how does that impact your actual tax return? Can K1 losses be used against other income? And what are the restrictions on that and all those kinds of things? So here's just up on the screen here, there's just a dummy K1 here with a business sample and client sample who lives in Richardson, Texas. If you're in Texas, let us know. That's a great state for taxes because there's no state income tax, at least on the personal level. If you have a business doing over 1 million, there is a extra tax there, but it doesn't apply to most. So on here, we've got this is a K1 1120S, meaning it's for an S corporation. And we're showing an ordinary business income of negative $8,000. So it's an $8,000 loss. So the first thing, whenever you get a loss on a K1, is the question you have to ask yourself is, do I have basis? And basis is a tax concept where basically it's asking, do you have enough investment into the company in order for that loss to be personally impacting? So, for example, if you get together with a few people and you put some money into a new company and you go out and you're trying to do the thing that the company does and it loses money, which is pretty common in the first few years, then that money that you invested creates your basis. If the company takes out debt that you are personally guaranteeing, that can increase your basis. If the company takes on debt that you are not personally guaranteeing, that generally does not increase your basis. So it could be like this happens in real estate projects where the new LLC is formed as a partnership. And then if the deal is big enough, it's secured by the property itself, or any new loan is secured by the property itself rather than the individual partners in the LLC. Then you are not personally liable for that debt. And then that generally does not increase your basis. Now, with all things taxes, there's always facts and circumstances, and so it's hard to give hard and fast rules. But generally speaking, the first question you have to ask yourself is, do I have the basis in order to take this loss? If I don't, the loss gets suspended, meaning that it doesn't impact your current year tax return. It gets carried forward to the future until you do have enough basis to absorb that loss. But let's turn over to the personal side, and we'll see how this flows through. So here is our client sample with the spouse sample living in Richardson, Texas. They have a son named Son Sample. So this is the before picture. We got $65,000 worth of W-2 income, and they've got their standard deduction. And then they end up with $2,200 worth of tax after taking the credit for the kid. It would have been 4,200, but they get 2,000 because they have an under 16-year-old. That's down to 2,200 bucks, and they get a refund of $2,700. So it's good start. Okay, so then if we look at the after picture, we have the same 65,000, and now we have a minus 8,000 here. So we are showing an $8,000 loss because we're saying that client sample has enough basis in order to take that loss on their taxes this year, and he was not a passive participant. So passive versus active, that comes in a lot with real estate type of things. If you're an S corp owner, generally you're going to be active, so it's usually not a problem. So we have 65,000 minus 8,000. So now our total income drops by 57,000. So the K1 loss does counteract or does go against the other income on the tax return. So 65 got dropped by 8, and now we're down to 57. So if we lower the total income, which is that line 9 total income, then the assessment of tax is going to be smaller because we're assessing tax on a lower number. So again, we have got the standard deduction, we got the credit for the kid, and now we're down to $1,300 of tax. So the refund went up to $3,600. So just because these people were already in a low tax bracket, they got a 10 or 12% increase in their refund because of the $8,000 loss. Basically went up by $800. If you've satisfied these conditions where you have other income, you have basis, and you're active, then those losses can go against those K1 losses can go against your W2 income or any other income, really. When you get into the active versus passive, it gets complicated. There's what's called the passive activity loss limitations, which is Form 8582, if you really want to know. And what it does is that it caps out your passive losses at $25,000. And that's up to making $100,000 of income. As you make between 100 and 150, that 25,000 starts to get crunched down and prorated down to when you get to 150, your passive activity losses are 0, and they get pushed forward into following years. So similar to what we discussed about the basis suspensions. So there's two different issues there: basis and then passive limitations. So yes, if you're set up in the right way, your K1 losses can deduct from your total income and reduce your total tax. There's a lot of caveats and a lot of caveats and details you got to follow there. But and then how do we maximize any potential tax losses that the IRS sees fit to grant is a whole other discussion that we go into with our clients, because generally we want to minimize income as much as possible, as long as we do it legitimately and legally, and then increase tax savings as much as possible. So that's it for today's Tax Sherpa Stories. And if you didn't get a K1 and you have a business, that's because you're Schedule C filer. And I'll go into another time why that is a terrible idea, especially going forward. You're gonna be a huge audit risk. But that's for next time. I'll talk to you soon.